hopefully Professor Bessen will continue the Lord of the Rings theme, proving once and for all that economists, lawyers, and patent law are all geeks.
So this paper comes out of work with Mike Moyer. Several years ago, we started a fairly large scale, or long-term project, trying to get at the empirical analysis of how well the patent system works, whatever pieces we could. I'm going to talk about one piece today, which is the private costs of patent litigation. We have other papers and a book called Patent Failure, which is out there, if you want to see what some of the other pieces are, and we have some more recent papers. But the whole idea, we hear these very strong claims about how well the patent system works and very strong claims about how terrible this litigation is and how bad it is. And we felt that we would all benefit if we could marshal whatever empirical evidence there is. So, motivating starting point, this is, just last year we reached a new record in the number of patent lawsuits filed, somewhat over 3,000 now. This is about triple what it was 20 years ago. So it's a pretty large increase. US, this is just US, yes. The US is the world center, well, I shouldn't say that. China actually has more patent lawsuits than we do, but overall, the US is the world center for patent litigation. Germany's quickly catching up. Even before smartphones, even before patent trolls had much imprint, there was something that was going on that was leading to a dramatic rise. This paper is to sort of start halfway answer the question of, well, how significant is it? What does it mean? We all know that the threat of patent litigation is important in terms of making the rights respected. But the occurrence is something we don't necessarily like, and so the occurrence of a lot of patent litigation might not be a good thing. Patent litigation, you might say, is something that we would like to honor in the breach, not in the observance. There are a number of different social costs. There are, of course, the legal costs, which is what often people focus on. There are diversion of resources, management distraction, engineers spent involved in litigation. Perhaps a large and often neglected deadweight cost is that there very often can be lost or delayed business associated with patent lawsuits, as customers don't want to buy something that's under threat or there's uncertainty. In addition to these static costs, though, and what may be more important in the long run, litigation, because it imposes costs, may actually make the patent system provide disincentives. The risk of litigation is a disincentive, so that when, and it's a disincentive both for the patent holder and for the alleged infringer. When someone goes to invest in a new research project, they anticipate what their profits will be. If they have to expect that there's going to be litigation down the road that's going to cost them, either to enforce their patents or because they're, in their view, perhaps unjustly sued, inadvertent infringement, that cost acts essentially as a tax on innovation. So it's a disincentive. And in particular with an alleged infringer, it may impose direct costs, but also things like increasing costs of credit, and there's also the possibility of having to pay a patent holder. And Catherine Tucker at MIT did a recently interesting example, which I thought just got it was a case study looking at a troll lawsuit in medical imaging. She studied the entire industry. For a 2-year period, there was a 30% loss of revenue that she was able to pin down as associated with the lawsuit. And there was no innovation by major companies for 2 years. They put off any product improvements or new products because of the uncertainty and perhaps some legal complications related to the lawsuits. So there are some real significant costs that can arise. I'm going to focus today just on private costs. And I'm going to focus mainly on private costs to the alleged infringer. And these are so many of what I identified as social costs are also private costs. I'm going to focus on this significance to the alleged infringer to the extent that these private costs act as a disincentive for those companies to invest in innovation. So it's clearly only a piece of the puzzle. We have to ask, well, what about the patent holders? What about the benefits from patents? Things like this. But you'll see sort of the method and where it goes, and it tells us something that's informative. So we're going to use a method that's widely used in financial economics called event studies, where we look at what happens around the filing of a lawsuit to the stock of a firm. This method was first developed by Cutler and actually Larry Summers back in a paper in 1988, where they looked at litigation between Pennzoil and Texaco. It's been well developed and applied in a number of papers to patents. We really, for the first time here, did it on a large scale. Many of these studies just deal with a couple dozen lawsuits. Here we're dealing with thousands, which is a significant difference. But to sort of fix ideas, is this a pointer? So this shows the stock price of a defendant and a plaintiff. This is an average. This is the day that the lawsuit was announced. This is the day before and 2 days before. And you can see that the stock price of the defendant goes down quite a bit, in this case close to 33%. The plaintiff's stock price does not increase and maybe actually goes down a little bit. The idea is to take those sort of reactions and infer a risk or a cost with them. The idea is that if the news of the lawsuit doesn't reveal unrelated information about the firm's prospects, then it reflects how investors think the firm's expected future profits have changed. So expected future profits change because of, you can lump all of those changes into a cost. Now there may be other kinds of unrelated information that come out, and I'll look at some of that later, but that's the basic supposition of this approach. So my gratuitous bit of math for the financial economists in the audience, the basic idea is we filter out the general effect of the stock market. So, we all know that if the suit was announced on a day when the stock market was down, well, the market's going to go down regardless of the lawsuit. We also average, or we do what are called cumulative abnormal returns, a bit of a tongue twister. We basically average these reactions over many days and over a large number of firms. And by doing that, we filter out all of the idiosyncratic reactions. So, a lawsuit may be announced at the same time earnings were announced, and so that may affect a particular stock. But if we're looking at several thousand events like this, we're going to filter out those sorts of issues. So where do we, our data, we're using the Derwent Lit Alert service, which manages to capture about 85% of the lawsuits. We're lumping, I'm going to use these terms patentee, litigant, and alleged infringer because we're looking both at formally infringement suits, but also declaratory actions where a patent's been asserted against a firm, and that firm then files a declaratory action requesting that the patent be invalidated or they be declared to be non-infringing. So we're switching those around and lumping them together. The patentee litigant is the one that has the patent, and the alleged infringer is the other one. We pull firm data and stock market data from CRISP and patent data from the NBER. And we built some pretty large samples. So we have 2,600 lawsuits, close to 2,900 different parties involved. We filter through those now we're focusing on public firms, so only a minority of lawsuits involve publicly listed firms, but those are going to be the larger ones in general, the larger companies. And we look both at ones where one side of the lawsuit was a publicly listed firm, and we have a sample of 700 or so where we were identifying both sides. We also did a subset where we looked at lawsuits that were also announced in the Wall Street Journal. I don't need to get into too much detail here. So if you look at the Wall Street Journal as a starting point, because this is what had been done in the earlier literature, you do see something like that chart earlier, where the alleged infringer has almost the 3%, 2.5% loss. The patentee litigant has a slight loss. And this is the general result from this literature. The defendants lose, and plaintiffs actually lose a little, but much less. This tends to suggest, and this is the interpretation in the literature, is that patent litigation is not a matter of simple wealth transfer from the defendant to the plaintiff. There's more stuff going on, that there's some dead weight loss. If we look at our full sample, we get a much smaller reaction, and that may mean in some way that maybe we're underestimating, but I'll be conservative and say we'll go with this. But it's about a 0.5% loss in the stock value is what a firm experiences. Okay, so what does that mean? How do we interpret this? Well, first, some qualitative information. We're able to look at different groups. We find that patentee litigants tend to lose more when they are less financially sound. There are some interpretations of what that means. I won't go into that here. Alleged infringers tend to lose more when the patentee is from outside the industry. In other words, it's a surprise lawsuit, perhaps. Or whether the patentee is an established firm, large firm, deep pockets, they're going to have a bigger reaction. Or when the alleged infringer is a small firms suffer more from litigation because their costs are relatively larger. Also, more recently, things have been a little bit larger losses have been a little bit larger. So one question is, okay, we see this reaction in stock prices. Is this loss just temporary? Is the stock market overreacting? We want to assume that stock investors are rational, but of course, we know that often they're not. After all, many large multinational banks are known to invest in the stock market. Obviously, not all investors could be fully rational. Well, we don't see signs of a correction. If we thought it was just a matter of investors coming in, getting nervous about the news, and then we would expect arbitrageurs to come in and then buy up the stock because it's been devalued too much. And if we thought it was just a simple kind of overreaction like that, we would tend to expect to see the stock go down quickly and then start to recover. Well, actually, if you look further and further out, it doesn't start to recover. It continues to get worse. So that doesn't seem to be happening. It might also be true that the greater uncertainty while the lawsuit is progressing drives the stock lower. But then you would expect to see the stock to bounce back up when things got settled. Well, there have been a couple studies which look at this and find that that doesn't happen. Stocks don't bounce back up on settlement. So we think these are really temporary. These are not temporary losses. Could these losses be due to something else? So we want to, extract the notion that this loss in wealth is related to a loss in expected profits, but it could be that the lawsuit somehow reveals other information, and if that other information were systematic and it were information that was private prior to the lawsuit, then it's possible that we could be seeing a spurious result that's not really related to the expected profit. So we go through a couple candidates here. For instance, suppose that the patent holder was filing the lawsuit in preparation for their entry into a new market, to the market where the defendant firm is. Then the suit would reveal that there's more competition for the defendant, and so there would be a stronger reaction. In fact, we find that the plaintiffs do not enter very, very few of the plaintiffs entered the market subsequently to the lawsuit. And we find out that when the plaintiff is an entrant, that actually the defendants lose less. So this doesn't seem to be this valid story. Another possibility might be that the suit reveals the quality of a poor quality of management by the managers of the defendant firm. Perhaps the firm is getting sued because the managers haven't done a good clearance search. Well, two things go against that. One is that the losses we find tend to be greater for more surprise suits, things that could not be anticipated. So, for instance, suits that come from outside the industry or suits that were filed the same year as the patent issued. Also, losses do not decrease after the firm has been sued multiple times. If it was just bad management, you would expect them to fix things. We're not seeing any significant time patterns. So this doesn't seem to be just a simple, reflection of poor management. A third possibility is that the lawsuit could reveal that perhaps the technological opportunity was greater than initially realized. This kind of goes, there was an old Silicon Valley joke that if you got sued, you must be doing something right. Congratulations. That could be true, but if it were true, then it would mean that our numbers underestimate the lost profits. So we're not going to worry about that one. We're going to be conservative. So basically, I'm arguing that the stock price declines that we see are not temporary, they're not derived from unrelated information, and that it does represent a loss. And we can think about the loss in two ways. One, it is directly a loss of investor wealth, and two, it's a loss of firm expected operating profits. So, how do these things tally up? How big are they? Well, we can estimate the loss of wealth by multiplying the CAR, the 0.5% loss, times the common stock capitalization. And what we come to in $1992 for this, and this was, now remember, this was from the period of a sample from 1984 through 99, a loss of about 50 million in mean, a 4 million median. One thing you have to remember is firm values here are highly skewed. There are, some very large firms, so the mean is going to be much larger than the median. This tends to be in the same ballpark as some other estimates. If we want to think about loss of firm profits or loss of firm capital, we can ask the question, well, how much investment would be needed to restore the firm to its prior value? And so we can get at that by a more conservative measure, which is to divide the loss of wealth by Tobin's Q. I won't go into Tobin's Q if you don't know it. This is a more conservative measure that corresponds more to the operating loss that might be felt. And it also filters out things like stock market bubbles. And here it comes down to a mean of 28 million, 29 million, and a median of 2.9 million. So these are numbers. Are they good numbers? Are they bad numbers? How do we put it together? Well, here's a chart of the aggregate risk to alleged infringers. And one thing that's clear is that during the late 90s, things were changing rapidly so that this number was increasing quite rapidly in aggregate. If we aggregate it, we get in 1984, it was $2 billion. In 1999, it was $16 billion for all the firms in our sample. We can relate that to R&D spending, initially 5%, at the latter, by the end of the period, 19%. And these tell me that this is a large number. There have been a number of studies where people estimate the value of how much extra value that patents add to R&D investment, how much of a subsidy they provide, and those numbers tend to be, am I running out of time? Okay, I'm good. Those numbers tend to be in the 15% range. So by the end of the 90s, we're getting something where the private costs of litigation are of the same order of magnitude as the benefits. Now, in our book, we find that this varies by industry. It is not true for pharmaceuticals or chemicals, but it is true for many other firms in the ITC world, information technologies and communication. And it's something to be concerned about. So to conclude, the infringement risk grew rapidly during the 90s. It's large relative to R&D. It's large relative to estimates of patent value. Its significance, one thing we can say is it acts as a tax on innovation. When firms are paying this much, it does mean that there is a disincentive. Now, it's possible that that disincentive could be offset by a positive incentive that patents provide, and that we go through that calculation in our book, and that's really beyond the scope here. Also, I'm talking about private losses, not social losses. We don't necessarily know that these losses correspond to a dead weight loss to society, but there's some evidence, namely the fact that the plaintiff values don't go up, that there is some significant dead weight loss. And that tends to be, the case studies like Catherine Tucker's tend to confirm that view. So thank you.
All right, so we have some time for questions for Professor Bessen. Yes.
So you're looking at patent litigation.
Yes.
Did you compare it to other litigation?
Oh, in terms of trends, yeah, we did. Well, you have a funny thing with copyright litigation because of the record suits. Aside from that, and if you filtered out the record, the RIA suits against, you're not seeing any comparable trend. If you look at other sorts of business litigation like contract.
I'm sorry, I didn't mean the trend.
Oh.
I meant you were drawing conclusions about the impact on the plaintiff and defendant previous ownership. I wondered if we look at other forms of litigation, in particular not intellectual property litigation, whether you would see similar effects.
So there, yeah, we did not ourselves. There is some literature on that. I believe that in general, these numbers are substantially larger. Very few of the studies have done a comprehensive thing, looking at the lawsuits in aggregate, in large numbers.
Very interesting paper. One thing you're finding very surprised me that the loss of the market value, stock value of both liquid and defendant are permanent. They're not temporary.
Yeah, I'm not sure. Well, that's not necessarily true with the plaintiff, but go on.
Yeah, did you take their cash flows at the same time?
Yeah, this is a standard problem in financial economics when you try to look out over a long term. So patent litigation is going to go on for 2 years or something, a year and a half on average, sometimes longer. It becomes very difficult to filter out those effects from other things that are going on in terms of where the market, you have to be able to ask what would the cash flow have been otherwise, and it's very hard to know that over a long term with any statistical accuracy. So it's hard to know. It's hard to use that measure.
Yeah, Tom.
Yeah, on the event study methodology, which I've engaged in from time to time, to look at the effect of things like Microsoft antitrust action. We specifically did not quantify the dollar amounts of those effects. It's very powerful to look, particularly across events, if you have a large number of events, to the direction of change, binary consideration. The market reacts up or down, and that yields a lot of information. But the actual dollar movements are not easily interpreted. That is to say, the day before some lawsuit is filed, you don't know what the probability that such a lawsuit might be filed is as anticipated by the market. And so you don't know if it goes from 0% to 100%, which seems to be maybe the implication here, and it has been in sort of the normal course of things. And so you can't just say that we saw something move and therefore this is the total dollar amount. Now, in some specific specific instances, you may be able to do that, but you have to be very careful when you aggregate that across events, and you actually don't have an estimate. You need to know more information than you can get normally. Now, what's affected that and allowed some estimations of total welfare, total surplus change, which is what you're after here, are prediction markets that actually will yield you some probabilities. So there's a nice paper by Justin Wolfers on the great natural experiment that occurred on, well, for the 8 hours of the John Kerry presidential administration. When on election day of 2004, the exit polls came out about 3 o'clock in the afternoon. Kerry was up fairly substantially, and the prediction market odds on a Bush re-election went from something like 75% to 25%. And during that space of time, you could see what was happening to the S&P 500, so you could pull something out of that in terms of what exactly the market was saying about the Bush, the value of a Republican president versus a Democratic president, or however you wanted to interpret that, that election effect on the market. But that's because you have contemporaneous prediction markets telling you how probabilities are changing. You don't know that without the prediction market, generally speaking.
Yeah, so I should explain something I didn't explain here. Our aim here is to get a lower bound estimate. The true number might be greater, but we want to get a conservative number that we can believe in. So we assume basically, yes, as a baseline, we're going to assume that the day before the lawsuit, there's zero expectation of a lawsuit. And so whatever we measure is what we measure. If it were true that it was a positive prior, then the number we get would be underestimated, that the true reaction would be even bigger, and the loss would be greater than what we estimate here.
Unless you're aggregating over events, and unless your windows may be of considerable size. Are you aggregating over events?
We're aggregating over a couple thousand events, and we're looking at a 200.
One event per lawsuit.
One event per lawsuit.
Just a related question. So how far in the future do you look at the recovery?
We looked at the recovery up to 25 trading days.
That's really, that's back to the point, it's really short, right?
Right. The problem is, what happens is, what happens is that basically the statistical noise, as you get further and further out, the statistical noise grows. So there are other sorts of biases that enter the picture in terms of firms starting to drop out or enter.
I'm just wondering if there's a way to get around this. And
yeah, there's not an easy way. There's not an easy way. So what we can do is we can look at what happens as the window going out, and we find that as we extend the window, we're not seeing a restoration of values. Actually, we're seeing a further deterioration. And the other thing is to look at what happens at subsequent events, so settlement or adjudication. And so that, again, we're finding that when those occur, we're not seeing a spike up on average.
So one clear measure for the valuation perspective, that whether your cash flow is changing or not, and the stock market can react based on the certain expectation of the market. But if your cash flows, you don't see that changing, and that's why the cash flow was important to look at, that whether really it is actually the farm is losing value over longer term or not. That would be that would be determined by your cash flow. And given that it is a short period of time, we cannot conclude that it's going to be a temporary upturn. Can you?
Well, you have to say, well, you need to provide really an alternative model about why it is that an arbitrager is not going to come in. If what's going on, why is it that the stock market hasn't reflected the actual values? And if it did, there would be an opportunity to make money. If investors have overreacted and driven the stock low, there's basically 10 lawsuits being filed a day, so you can, there's an opportunity for a hedge fund to make a lot of money if all they had to do was to wait until the stock dropped and then buy and sell when the thing settled. But it doesn't, we're not seeing any evidence that that's happening, at least within the first window. And they're just methodological problems in terms of looking at something like cash flow. You don't know what the cash flow would have been otherwise. You're dealing with cash flow. You're dealing with annual statements, which are things lumped together. You're not here. We're looking at daily data, so it's very. There are a whole series of.
You can use a quarterly statement as well. You can use a quarterly statement, see how.
Right.
I'm going to take just the moderator's prerogative to just ask one last question here, which goes to your very first slide, the patent explosion, which is a mem that you hear today. But if you actually adjust litigation rates to number of patents issued, and compare that to previous litigation rates, and I'm referring to the work of Zarina Khan. The average patent litigation rate in the 19th century, starting in the antebellum era all the way up, was ranged between 1.2 and 3.5%. And the average litigation rate in the past 20 years or so has been around 1.5%. So does that impact? So essentially, litigation rates have remained almost the exact same for approximately 200 years. So is this impact your study?
Well, first off, Zarina and I have had an argument about whether that she's only dealing with published lawsuits, so there's a difficulty in terms of her data. But aside from that, two things. Yeah, we look at things like what is the probability that a patent will be in a lawsuit, and we see that as distinctly going up. Second, the number of patents in lawsuits, per lawsuit, has gone up. So part of this is there is an increase in patents, but some of it is related to multiple patents, essentially on the same inventions. So it's hard to make any sense of that. I think it's very difficult to maintain an argument, though, that this is just sort of the normal way things are, and it's because we have more patents. There's something more going on than just patent inflation.
Adam, we're late for lunch. Please join me in thanking our great panelists, Ann and James. Where's the food?